1031 exchange. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. And today we're back with another installment of What is that? Where we discuss financial terms and topics you may have heard, but we make them super easy to understand. Today, we're talking about the 1031 exchange specifically as it relates to real estate. This is when you're about to sell a real estate asset and your plan is to use those monies to invest in another real estate asset right away. If you own rental properties and you've heard about this thing called the 1031 exchange, this video is for you. So tune in and let's get started right at the beginning. 1031 exchange. What is that? Section 1031 is the section of the Internal Revenue Code that allows investors of real estate to defer taxable gains on real estate as long as they exchange it for like-kind property. You see, when you sell real estate, you're typically subject to capital gains tax, assuming that you've held that property for more than 1 year. Capital gains tax could be 0, 15%, or even 20%, depending upon your total income that year. These capital gain taxes can really eat into the profit of the equity that you've built in this real estate asset. And if you're just going to turn around and buy another real estate asset, you don't want the IRS dipping their fingers into that profit. I want to be very clear that a 1031 exchange is not related to your primary home. There's a whole nother exemption for your primary home, which you can explore. 1031 exchanges really have to do with investment properties. Let's get into the rules and process of doing a 1031 exchange. In a perfect world, you sell your real estate asset and you've already super easily identified the next real estate asset that you will purchase. However, the market could be kind of tricky and things move fast. Or maybe you're looking for the perfect next investment and you haven't really yet identified it. The 1031 allows for some flexibility, but not much. Here's how it works. Essentially, you have a middleman. This is a professional who is holding the funds from the sale of your investment property while you are searching for your new investment property. This is typically a title company or a real estate attorney, and you really want to make sure you use someone that is familiar with this process. Now, there are two timing rules that are super important in this process that must be met in order for you to have the tax benefit of the 1031 exchange. So the first timing rule is the 45-day rule. After you sold your property, the intermediary has all the cash from the sale. You can't receive any of it because that would spoil this 1031 treatment. The 45-day rule says that from the time you've sold your home, you have 45 days to identify the new property that you will purchase. The IRS actually lets you identify up to 3 properties. Well, actually more, but they have to fall within certain valuation tests. So for this video, let's just stick to 3. You have to identify at least 3 properties in writing to your intermediary that you have designated will be the next like-kind real estate investment. 45 days is short. That's about a month and a half. So you have to really act fast. The second timing rule is related to closing on the property. The IRS says that you must close on that property within 180 days from the time that you sold your property. It's very important to note that these 2 dates run concurrently, which means that the 180 days doesn't start once you've identified the next property. It starts once you've sold your last property. 180 days is essentially 6 months. And since you already took about 45 days just to identify that property, you're running pretty short on time to close. I would say less than 5 months or so, maybe 4.5. So you've got to act quickly. One last thing I want to say about 1031 exchanges is that it is a tax deferred strategy. You're never completely avoiding the tax bill because eventually you will have a sale in which you might not invest into a new property. Ideally, you continue to do this process until you've deceased and allow your kids to inherit this property in which they receive step-up basis. And now you have completely avoided paying taxes on all this built up equity. Hence why the government wants to get rid of step-up basis. A lot of people look the other way in doing a 1031 exchange because they really want the cash from the sale of the property. And the 1031 exchange says you can't actually get any of it because then it would be taxable. There's a way around that though. You see, if you do a 1031 exchange where you reinvest all the money into a new property, you have this tax deferred treatment. You could then refinance that property, take the equity out, have debt, which sucks, but debt is not taxable. And so this is a way in which you can still get the cash funds from the sale without actually having a taxable event, hence a tax loophole. We hope you enjoyed this latest installment of What Is That? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.